Ladies and gentlemen, we might get started just in the interest of time. Hello and welcome to you all joining us for this economic update. I'm Jamie O'Rourke, the Chief Executive Partner of RSM Australia, and I'm delighted to have you with us today. I would like to acknowledge the traditional custodians of the land that I'm on today, the Wurundjeri people of the Kulin Nation, and I'd like to pay our respects to the elders past and present. Ladies and gentlemen, we coined this update bracing for impact. And that's because Donald Trump has been confirmed as the next president of the United States and a Republican sweep of Congress. So global markets are already starting to react to the anticipated shifts in policy. So as we close out a year of relatively strong global economic growth in Australia, the new and significant variables like potential changes to trade policy, monetary direction, and fiscal priorities are now firmly in play. Closer to home, Treasurer Jim Chalmers has already cautioned that Australia won't be immune to the fallout of a possible trade war if the incoming administration moves forward with the sweeping tariffs on Chinese imports as they have discussed. These dynamics raised pressing questions about the trajectory of growth, market stability, and the business opportunities on both sides of the Pacific. We've got two great economists from RSM to join us today. But before we go to Joe and to Devika, who I will formally introduce, I would also like to welcome the global CEO of RSM Worldwide, Mr. EJ Netta, who is joining us today. He's in Melbourne with us. In fact, we had a national partner meeting last week in Brisbane, and EJ came out and explained a whole lot of things strategic for RSM around the world. So I thought EJ's been in his role for 6 months, and during that time, he's visited 5 different continents and met the RSM member firms around the world. I thought, EJ, if you could maybe just share a couple of insights as to what the middle market of the world is seeing through your eyes.
Thank you, Jamie, and glad to have all of you joining us here. As Jamie said, I stepped into the global CEO role in June of this year, and it's been an absolute pleasure to get to go around the world and hear about all our great member firms and the work that they're doing. Some of the perspectives I've heard are that you think about the middle market, which is a core focus for us. Our member firms are strong and in a great position of advising and helping our clients. But we do see a lot of trade pressure and a lot of financial pressure that's continuing, and we expect to accelerate to a certain extent in the upcoming year. You'll hear from Joe and Devika on those key matters. But I will tell you, the middle market's been resilient, continues to be resilient, but they'll have new challenges to deal with as we start to see trade change globally. And I'm excited for this conversation and hope all of you will enjoy it. So thank you, and back to you, Jamie.
Thanks, EJ. And yeah, while there's challenges, there are always challenges. So the idea of today is to try and provide with some insights, some interpretations of what might happen so that you can use this information to better plan for the challenges that may come forward in your business. So we've got 2 fantastic guests. First of all, joining us from Austin, Texas, and Joe, I apologise, Sunday evening, where you are at the moment. So great that you could join us today. He's the chief economist of RSM in the US and is a widely respected voice on US economic policy. He has more than 20 years of experience analysing US monetary policy, labour markets, fiscal strategy, and Joe is an award-winning economist and a member of the Wall Street Journal's forecasting panel. He regularly briefs members of Congress on the real-world impacts of federal policies and provides invaluable guidance to executives making critical business decisions around the world. And then also we have Devika from Australia, our own in-house economist. And Devika has a deep expertise in macroeconomic issues across both the public and the private sectors. Devika brings a nuanced understanding of the Asia-Pacific region and is a frequent commentator in the media on Australia's position in economic order. With a talent for distilling complex dynamics into actionable insights, Devika will help us assess how the US election could reshape the economic environment here in Australia. We've already had a number of questions, many questions that have been posted. So we will get to those. We've grouped them and we will get to those. But if you have any questions, if I could ask you to put them in the Q&A chat. So, Joe, if I can go to you first, and please, we see everything through an Australian lens. I'd be very interested to hear how you're seeing things through the world lens, given the now announced change in administration that will occur on the 20th of January 2025.
Well, thank you, Jamie. And it's certainly good to be here. And I appreciate everybody on the call. Good morning. It's good evening where I am at. But your most valuable commodity is your time. And I'm so pleased that you're going to share some time with all of us today. So the global economy in 2025 looks to grow somewhere between 3 and 3.5%. While that's not at the rate that we grew accustomed to prior to the pandemic, it is an improvement, and it will largely be driven by the two big economies of the United States and India, not China, and we'll get to China in a moment. In addition to pretty solid growth. In the US, it'll be probably around 2.5 to 3%. In India, you're looking in the 6 to 7% range. But the primary driver is going to be the emerging markets, who we expect to see growth in that 4 to 5% range next year. Of course, when we talk global economics, we have to talk commodities. The most important commodity out there is the price of oil. It does appear that in 2025, we're going to have a global surplus of about 1 million barrels a day, which will effectively put a cap on oil prices, which is good for the global economy, which is still emerging in many cases from the price shock that followed the shutdown of supply chains and the reopening of the overall international economy. Now, my sense here is that what you're going to see is the United States continue to drive overall economic activity just due to the fact that its economy, again, is going to grow between 2.5 and 3%. It has a very low unemployment rate right now of 4.1%, but it's consumer based because wage growth in the United States for the past 18 months has been advancing above inflation. What that means is you're going to see robust consumer spending, somewhere in the range between 3 and 4%. Now, as we turn to the policy matrix, the real challenges are going to come from the new policies that are going to be adopted by the Trump administration. Two big important things, and these are the things I would hope you take with you. First, the US is likely to adopt an expansionary fiscal policy. That is, you're going to see lower taxes and increased federal spending, which in turn will create increased personal disposable income across American households, who will then turn and spend that capital by vacuuming up excess production everywhere across the world, except from China. And again, we'll get to that in a moment. So what that means is the United States is likely, all things being equal, to see an increase in its already large trade deficit. And that's where we get into some of the challenges of the new Trump administration, because you have heard that the Trump administration intends to adopt a new tariff regime that is increased taxes on imports from around the world. Now, my sense is we have to separate out the campaign rhetoric from the grim realities of governing. And what we expect to see early in 2025 is a series of tariffs put on Chinese imports, which will have an indirect effect on other Chinese trade partners in general and Australia in particular. Okay, so what should you expect? Well, currently, U.S. tariffs on Chinese goods sit at around 25%. The average is closer to 12%, but the really big value-added products have a fairly high tax on them. The Trump administration is expected to increase those tariffs by somewhere between to a rate of an additional 20%, and in some cases as high as 60%. Now that will roil the global economy in a number of ways, but we should expect to see that as early as January 21st in the United States, and this will carry a cost. Now, when the Trump administration put tariffs on Chinese goods in the 2018 to 2020 period, we did see an almost one-for-one depreciation in the Chinese yuan. And the Chinese clearly intend to take retaliatory steps. So what was a trade skirmish during the first Trump administration, we want to watch this closely to make sure it doesn't turn into a trade war, where you get bigger thy neighbor currency depreciations, capital controls, and other things, because that's not in the interest of anyone. Now, when we think about the global economy in 2025, I think we need to start with the role, status, and value of the US dollar. Over the past year, since late December of 2023, the US dollar has appreciated by 7.5%. And you should expect that to continue. And because the dollar's on such tear, it's going to cause some issues in the global economy, specifically for large emerging markets that have prodigious quantities of dollar-denominated debt, for economies that have currency pegs, and economies that have large external debt. This will entail a period of transition because the cost of servicing that debt, the cost of maintaining those pegs, the cost of importing oil, all increase, which creates the conditions for a slower pace of growth than what would otherwise have been seen, and a possible resumption of inflation via the energy channel. Now, at the heart of the Trump policy is an internal inconsistency. It wants lower taxes, increase government spending, but it wants to narrow the U.S. current account surplus and U.S. trade deficit. So something's got to give. Typically, what gives is you get higher interest rates in the United States, which then in turn serves to act as a magnet for global capital. Through the middle of 2024, and I really want to lay this out, the level of foreign direct investment and capital inflows in the United States was larger than the next 12 economies combined. That's likely to accelerate in 2025 and into 2026. So there's going to be friction, even as the global economy accelerates. And some economies are going to have a more difficult time adjusting. Now, I laid out a scenario where we're going to see 3 to 3.5% growth globally. It'll be driven by the 2.5 to 3% in the United States, the 6 to 7% in India. In China, their goal is 5% growth. But to be honest, it looks like their economy is growing closer to 2 to 3%. Now, I know since the election of Trump, attention has rightly turned to tariffs and non-tariff barriers and a disruption of global finance and global trade. For Australia, again, those impacts are likely to be indirect or second order, at least at first. The major challenge globally, separate from the United States, but more pertinently for Australia, is the fact that the Chinese are caught in a debt trap. They've entered a multi-year period of debt and deleveraging. Typically, when an economy enters a period of debt and deleveraging, it takes about 7 to 10 years to work through. And the properties are very simple. Households, firms, and in some cases, state and local governments and the national government all will enter a period of deleveraging, meaning working down that debt. That means slower growth. That means definitely a more difficult period of adjustment in which the Chinese are attempting to export their way out of it. They're exporting the burden of adjustment to other countries. The Chinese are essentially asking their trade partners to accept a reduced share of global manufacturing. Now, one of the things that's different is that right now, the United States, Europe, Japan, South Korea, and Australia are not really willing to accept the surplus production of China. So this creates conditions for real frictions, trade frictions, frictions in global finance that likely will spill over into geopolitical and other security tensions that are already there in Northeast Asia. You know, when the United States recently went through its period of debt and deleveraging that started in 2007, and then for all intents and purposes didn't end until 2014. The Chinese, I think, are about 2 years into this. So at best, we've got 5 years, at worst, probably 8 years until they're through. Now, when we think about the collapse in housing prices and in commercial real estate around China, we've got a situation where their state and localities have very large quantities of debt. The Chinese say that there's 14 trillion yuan of debt at the state and local prefects. The International Monetary Fund says that's not likely the case. It's closer to 60 trillion. So we're just going to be in a period where the global economy is going to go through an adjustment. The primary driver of growth, at least since the great financial crisis, has been China. That baton's now been passed to the US and India. And what it means is we're going to be diversifying away from risks, whether they be firms looking to avoid increased export taxes into the United States, which means essentially forward can in terms of your own economic activity to avoid indirect or direct taxes. Second, diversifying your supply chains to get closer to your markets. In many cases, we see firms leaving the Chinese supply chains, moving into other areas. Vietnam, Indonesia, Malaysia, they tend to be the winners in Asia. Here in the Western Hemisphere, Mexico's definitely the winner as firms relocate or think about relocating to the North American free trade zone. Now, my sense is most of the major trading countries have gone through 4 years of Donald Trump. They have an idea of how things work. Now, my advice on this is to take him literally. He believes in tariffs and he believes in them as an instrument of negotiation or leverage. Now, my sense when it comes to the Chinese, there's not much to negotiate. He intends to keep their electric vehicles out of the North American free trade zone. He intends to limit the import of high added value tech because the United States, and this is, I want to be clear here, this isn't a function of Trump. This was done under the Biden administration also. It intends to protect its artificial intelligence industry, its quantum computing industry, and it intends to create a hemispheric market for critical and sophisticated microchips. So in many ways, this is just a continuation of policy that's already been put in place, perhaps with a steeper set of tariffs. And of course, there'll be a focus on transshipment, because what this administration won't tolerate, and it didn't in the first administration or their first 4 years, is firms essentially that are Chinese in origin moving to different countries and then just selling through different markets to gain access into the United States. And remember, in the United States, manufacturing only accounts for 10% of its $29 trillion GDP. 90% are services. The United States is a large, globally important country. It is on 90% of the $6 trillion a day churn in global capital markets. Of the $31 trillion global bond market, the United States accounts for about 23 trillion. It literally is the benchmark for the entire global economy. So most of that economy will continue to operate as is, but on the margin, there will be frictions in trade, finance, and geopolitical security concerns because of the competition with China. Now, my sense is the Trump administration will need to get legal cover from the Congress to impose a 10 or 20% tariff on all imports in the United States. My sense is that that's just not going to happen in 2025. That may be in the out years, and that would have to be legally binding, an act of Congress, something that the United States hasn't done in almost 100 years. Now, in closing, before I want to turn it over to Devika, the global economy is going to grow. That growth may not be as impressive as what we observed prior to the pandemic, but it will be growth nonetheless. There will be opportunities, even as China sees its economy grind towards much slower growth. There's still going to be opportunities to be had. Oil, which was one of the primary causes of inflation in the post-pandemic era, the price for Brent crude will trade probably between $70 and $75 a barrel next year, with the likelihood of lower prices and a move into the 60s, simply because there's too much oil being produced relative to demand. Second, my sense is many of the trade frictions can be managed, but we're all going to have to learn to operate in a different way, because we've reached a point where the Chinese have decided to export the burden of their domestic political and economic adjustment onto its major trading partners, who in turn simply are not willing to accept its surplus production into their own economies at a time when populist politics around the world are focused on domestic employment and manufacturing. So we are entering a new era, and that post-pandemic global economy is beginning to take shape. We're going to do okay. We're all going to grow, but there are going to be some new challenges, and those challenges at times may get quite noisy. And it's good that we have forums like this where we can talk to each other in open and transparent ways to find common ground, again, to navigate those disruptions and those frictions. Thank you for your time. I want to turn it over to my good friend, Devika.
Thanks, Joe. We will come back. Don't go anywhere. We've got questions already coming in the Q&A box, so don't go anywhere. Devika, if we were doing this 3 months ago, it would be about interest rates. It wouldn't be about the bracing for impact from a new Trump administration. So Joe's talked about a 7 to 10 year cycle of debt and deleveraging. We're 2 years in. That's going to have a massive impact on Australia. How are you seeing the Australian economy in this new Trump administration?
Thanks so much, Jamie, and thank you so much, Joe, for the insightful talk. Let me perhaps start by giving a quick overview of where we are at today, and perhaps I think I would also like to touch upon how important the United States is for Australia, because its importance can't be underscored, and I think those couple of numbers might just help our audience understand how much of an impact and how much should we actually brace for Trump coming into power. So I'll quickly give a brief of that and then maybe touch upon some points that I feel are pertinent to Trump becoming president and how that impacts Australia. So looking at the Australian economy, our growth has remained quite subdued. Inflation is gradually easing, but services inflation still persists due to a tight labor market. In fact, policymakers have been surprised by the resilience of the labor market conditions because they have a dual impact. Number one, it eases wage pressures when there's a larger workforce, but simultaneously, it also has the potential to drive consumption up as more individuals earn incomes. Now, participation rate has remained high, making it easier for businesses to find labor. However, skill mismatches are a continuing challenge. Now, we believe hiring activity is being fueled by two factors. Number one is weak productivity that Australia has been grappling with, which has been forcing businesses to expand headcount to maintain output. And on the second hand, sustained demand for laborers in the public sector area, particularly in healthcare and construction space. There's also a time where education hiring did see an upswing, but financial pressures from declining international student enrollments are likely to dampen that going ahead into the next year. On the monetary policy front, despite headline inflation breaching the RBA's 2% to 3% target, we anticipate a shallow easing cycle. Our base case projects rate cuts beginning in the first quarter of 2025, though this could be delayed to the second quarter as the RBA prioritizes a sustained reduction in core inflation, which is still sitting at 3.5%, outside of the RBA's desired target range of 2% to 3%. Now, I believe as we are here today, I think I would like to shift the focus on from when would the rate cut start to how much are they going to be cut, because I think that's a much more important conversation to be had. The time of rate cuts is likely to be influenced by a lot of moving parts in the domestic as well as the global economy, but I think any forward-looking central banker would be looking at how far do I want to ease the interest rates to make sure that the economy does not get destabilized regardless of the moving factors, whether we are looking nationally or internationally. We project a terminal rate of 3.35% by the end of 2025, reflecting a modest 100 basis point reduction only. So if we were to begin interest rate cuts in the first quarter of 2025, I would say one 25 basis point cut each quarter to take us down to 3.35%. If the cuts are moved back or pushed back from the first quarter, I would expect the second quarter easing to be around the 50 basis point mark, followed by 25 basis points in third quarter and 25 basis points in the fourth quarter. Now, why do I see a risk of the RBA delaying its cuts further? I think it would be helpful to understand that we will be heading into a federal election in May 2025, and we have a pre-budget election scheduled somewhere in March. So there is a risk that there may be a fiscal boost coming in that pre-election budget. So that is what the RBA might be looking at, as well as the fact that core inflation is still trending down quite slow. Moving on to businesses, I think it's important to note that in Australia, insolvency numbers are climbing as banks and the ATO resume enforcement of overdue debts. Now, this reflects a backlog of cases deferred during the pandemic, when leniency measures provided some temporary relief, I would say. Many businesses that survived due to those subsidies are now succumbing to financial pressures, compounded by high inflation and elevated interest rates. Now, retail sales per capita has also been declining as high living costs and rising interest rates erode household spending. Over here, perhaps I would like to draw a comparison with the United States. We all heard Joe when he said that the United States consumer is in an extremely strong position, which is not the case in Australia. This pressure on consumer demand directly has been impacting business revenues here, creating a cycle of financial strain that can lead to further insolvencies. We've got a broad overview of what Australia has been going through. Now let's look at it. Now let's try and understand how important the United States is for Australia. I firmly believe that we can't underscore USA's importance enough. I mean, that relationship is pivotal. The most important governing factor in this bilateral relationship is the Australia-United States Free Trade Agreement, implemented in 2005, and it has been completely transformative for Australia. Since then, bilateral trade in goods and services with the United States has more than doubled to $98.7 billion as of end 2023. Key Australian exports include gold, meat, and financial services, while American exports feature machinery, vehicles, and technology services. Now, two-way investment has also tripled, with US investments in Australia reaching $1.2 trillion and Australian investments in the US at somewhere around the similar 1.21 trillion mark. And this, in fact, the US direct investment into Australia is the largest in the Indo-Pacific region. Over 10,000 Australian companies sell or operate in the United States, and Australian companies employ an estimated 180,000 people in the United States. From a defense perspective, I think this is what people in Australia are most interested in knowing, and which also has somewhat of a direct implication because of Trump coming into power, the AUKUS partnership, which highlights the strength of this alliance. Now, efforts are underway to enhance Australia's nuclear-powered submarine capabilities and to develop these advanced military technologies, promoting stability in the broader Indo-Pacific region. It is going to cost the Australian federal government about $368 billion over the next 3 decades. While it is aimed at deepening this collaboration between the two nations, there is no denying the fact that it is a significant expense on the government purses. Now, of course, when we discuss bilateral relationships, we cannot do justice to that discussion if we don't look at the politics of it. Now, Trump 2.0 will likely bring bolder and more unpredictable policies. I think Joe touched on a lot of them quite well and quite deeply. What I believe for Australia is that the first half of 2025 is likely to be focused more on policy formulation by Trump and his cabinet, and the effects of these policies will be more apparent towards the tail end of 2025 and well into 2026. I think the question on everyone's mind is probably, what if Trump slaps tariffs on Australia too? We are all aware that he's keen to slap tariffs on China, but what if he does that on Australia? Now, there's a very interesting dynamic here between Australia, the United States, and China. I'm not sure if everyone knows this, but Australia is one of those countries where we have a trade deficit with the United States and a surplus with China. So this should somewhat reduce considerable pressure on the tariff front for us. However, the only area that we see an increased risk to is the pressure to ramp up spending in the defense space, particularly in the with the AUKUS partnership. Barring the Trump factor, I would say in the short to medium term, the strength of the US economy that Joe very well highlighted for us is a bigger influence for Australia. While Australia stands to benefit from the United States' strong economic performance, which is obviously likely to bolster global commodity demand and investment flows, a robust US economy may also exert upward pressure on global interest rates, posing challenges for us here. We are all aware that the RBA doesn't necessarily move in lockstep with the US Federal Reserve, but it does have to move somewhat in sync, even if it is with a lag. So a robust US economy means higher spending. Higher spending means greater demand for goods and services and the risk that prices remain elevated. If prices were to remain elevated, it forces the United States Federal Reserve's hand to really reduce the pace with which it starts cutting interest rates, which means it has a ripple effect globally. So in summary, I would say that the US-Australia bilateral economic relationship is definitely a cornerstone for both nations. But in all honesty, I think it is a bit too soon to perhaps expect any significant ramifications for Australia as of today. For us, the short-term to medium risk comes more from the strength of the US economy, but we are likely to see the effects of Trump's policies on Australia and broadly China more in the 2025-2026 time period. Of course, we have to be mindful that Australia is in a very unique position, given that the United States and China are both its largest bilateral trade partners. So if the United States and China were to engage in what we hope not, is a trade war, Australia would definitely be caught in the firing zone.
Thank you, Devika. And you say that there's a lessened risk because the US has a surplus with us, whereas we have a surplus with China. And when you say less risk, that means that we've got a chance at the negotiation table to justify less tariffs or no tariffs, hopefully. And let's hope that's correct. Joe, a couple of questions have come through on immigration. You didn't touch on it, but there's a lot of talk, certainly leading up to the election, on one of Trump's key policies being to deport a lot of individuals back to their country of origin. Now, you've said they want to reduce their inflows from China. They want to do more manufacturing themselves. You've said they're only 10% of their GDP comes from manufacturing. But if they move a whole bunch of people out of the US, how are they going to do this? What
I mentioned
going to have on the US?
I mentioned the inconsistencies at the heart of the Trump agenda. And while he wants to reinvigorate the manufacturing sector, we simply can't do that without the labor we've imported from around the world. So tighter immigration does carry two problems. First is that it's going to cause real issues in agriculture and manufacturing and construction and leisure and hospitality across broad swaths of the US economy. The real issue, though, over the medium term is if he does intend to deport millions of people, which seems practically impossible. And literally, it won't happen next year. It's something that will take time, they'll have to get budget for, they'll have to plan out. And really, from my point of view, it's a 2026 and beyond issue, is that if they do that, with the US unemployment rate sitting at around 4.1%, we just don't have enough native-born workers to meet the demand across not just the lower added value, what we call traditional economy, but especially up the value chain, where we import large numbers of people with advanced degrees who work in tech, who work in life sciences, that really propel the US economy forward. You know, in 5 years, we're likely to be short 6 million people. If the administration were really to plow forward on this, it would create the conditions for unemployment to decline, wages to go up, which then sets the predicate for a possible wage price spiral and much higher inflation. So that's that inconsistency, that tension between its goals on manufacturing and what it's told the public it's going to do on immigration just are fundamentally not consistent. So again, something's going to have to give. And if that's the case, that's one of the reasons why, at least since the president-elect was announced as the victor, you've seen investors bid up long-term yields from 10 years to 30 years on the US Treasury maturity spectrum. You know, what's interesting is next year, we expect the Federal Reserve to cut rates between 0.5% and 1%, 50 basis points and 100 basis points. The front end of the curve, 2 to 5, the belly of that curve will likely see rates fall, which is very good for private equity and finance and financial services and energy and tech. But that long end is likely to increase. We have a 4.5% target on the US 10-year yield at the end of 2025 with risk of a 5%. I mentioned our base case on growth, which was 2.5%. The alternative to our base case, the base case was 55% probability. The alternative is a 30% or 20, excuse me, a 30% probability, whereby we see the US economy grow by over 3%. And that's when we'll start talking about rates of 5 to 5.5%. So there is quite a bit of internal tensions inside the US economy that will spill over into financial markets. And again, one of these things will have to give, because all of them can't happen at the same time. So and that was thank you for asking that question on immigration. It's just not pertinent to the 2025 outlook. It's really 2026 and beyond.
Thank you, Joe. Devika, we are essentially a mining country. One of the questions is, what are the likely effects of the tariffs that will be placed on all countries, but in particular China, and then their capacity to continue to buy our iron ore?
Yeah. So I think for this, Jamie, there's been a very interesting dynamic that's been going on in China, which I often speak about. It is that the residential sector, particularly, in China has been extremely weak. And as a result of that, following the pandemic, we have been seeing that the demand for some core commodities from Australia, particularly things like iron ore, copper, aluminium, they've all been falling because the demand from China is so substantial in our external sector that none of our other trade partners are able to revive that amount of demand. So it has been on a seesaw. Now, what China has done in order to support its economy, I think Joe touched upon that, and I will speak a bit briefly as well, is that with the weakness in the residential construction sector, it has moved to what has traditionally been its stronghold, which is the manufacturing sector. Now, in the manufacturing sector, China has been focusing predominantly in the new energy vehicle space, which primarily means what we know here as EVs. Now, it was just in the recent news that Australia is being flooded by a lot of EVs, and however, those EVs are not being sold very fast because there are a couple of challenges when it comes to managing EV sales here. Number one is lack of proper infrastructure, and people are still going in that hybrid space rather than investing completely in an EV. So broadly, what does that mean for our mining industry in Australia? Core commodities, iron ore, copper, aluminium, and lithium. Now, with the residential construction sector being extremely weak, we can expect iron ore demand to be somewhat weak unless it is offset extremely well by our other trading partners, which doesn't look like it's happening. Our iron ore dependency is still extremely high on China. Now, because that focus has shifted from iron ore to lithium now, and Australia is one of the largest producers of lithium, largest producers and exporters. There's a very interesting dynamic here as well. China does not import lithium directly from Australia. It invests in lithium mines in Australia, then ships it off to China, uses that in the EV space, and then sells those EVs back into Australia. So it doesn't do a direct trade when it comes to lithium. So I believe broadly for the commodities and in the mining industry, I would say the weakness from China is likely to persist for the next 6 months at least. And if Trump's policies are to slap some more tariffs, which might decrease the appetite for China to look outward for its resources and make it look even more inwards, I think it would have a material impact on commodity prices and as well as the Australian dollar.
Thank you, Devika. Here's a question on an alternate currency, Joe. What impact will crypto's rise have on traditional markets, and what role does crypto play in the future versus US dollar?
Okay, so crypto is a highly speculative, very risky asset. When crypto was first introduced 2 decades ago, it was positioned as the successor to the dollar. Okay, well, that's not the case anymore because stablecoins are predicated on the value of the dollar, right? It's predicated on the stability of the dollar. So we see them moving in tandem. Now, my sense is that crypto is going to break $100,000 per unit tomorrow morning when trading opens in the United States. And it will likely continue to rise for some time, but I see a financial asset bubble has formed. There's no economic value or rationale for crypto. It's just simply another speculative asset. I liken it to a very risky table in the back dimly lit corner of a casino. If you want to play in the market, I think that's great, but you should only do so with capital you're willing to lose. When I see global currency markets, the US dollar is 60% of all reserves. When I add in Canada, Mexico, the UK, European Union, Australia, Japan, South Korea, you're up above 95% of all reserves. That's the dollar block. Crypto is not going to replace that. Crypto will be part of a most global mosaic of financial assets, some more exotic than others, but I don't expect it to be a major factor in the global macroeconomy or the domestic microeconomies of the major trading nations.
Thank you, Joe. And Devika, what about impact on the Australian dollar? What do you think?
Yeah, thanks. I think that's another important question following if Trump's policies are inflationary. And the second question I always get asked is, what about the AUD? So I think let me weave that into a story and connect that with how everything moves, particularly RB as well as the AUD as well as the trade dynamics. So I think if we are to think about these upside risks from Trump coming into power on the Australian economy, its currency and its trade, we have to understand that most of our exports go to places that don't use the dollar, such as China and Japan. Now, in recent days, if you check Bloomberg, most of these currencies have tended to track below the Aussie dollar and fall even more against the US dollar in comparison to how the AUD has been faring. However, Australia's reliance on exports to China may slide if Trump's anti-China tariffs do get enforced as sharply as he's claiming he would. Now, weaker demand for Australia's currency would, all things being equal, push down its value, further complicating the matter as our imports would get more expensive. Now, to the extent that these imports can't be substituted, inflation will be higher than otherwise forecast, which means tradable inflation becomes a risk. Now, what does that mean? On one side, our value is getting pushed down because of our reliance on China on the trade side. But on the policy front, the RBA is definitely not going to be happy with the tradable inflation risk possibility. So our interest rates do not come down as fast as they should. Now, if the US Federal Reserve continues on its easing path, but the Reserve Bank of Australia is not able to follow the United States, it naturally appreciates the Australian dollar. So net, on one side, trade is going to pull the Aussie dollar down, but our monetary policy is likely to keep it elevated. What that means is, to some extent, there's a chance that the Aussie dollar's negative and positive, the appreciation and depreciation might just get offset. So the outlook for the Australian dollar is broadly unchanged as of today, unless trade factors, as discussed, and the divergence in central bank policies do not, destabilize the whole structure too much. So net, I think it's safe to assume that the Aussie dollar should stay around an average of 69 cents.
Thanks, Devika. That is good to hear. Staying just back with you on immigration, and there's been a lot of talk about immigration quite some months ago, that we need more immigration to actually grow and improve GDP. More recently, it's been we need to reduce immigration for a whole bunch of other reasons. With what's happening in the US with the illegal immigration and the Trump administration saying that they would like to export that, what opportunities does that open up for Australia?
Well, Devika.
Yeah.
Yeah. So I think, look, if it's illegal migration, Jamie, I think we'd rather not want those opportunities in Australia. But what I believe is our over-reliance on migration stems from the fact that we have to think back to the pandemic time, when people thought that the lockdowns in Australia were quite strict, and the people who were on temporary residential status moved out of Australia, which predominantly are the ones who are engaged in the Australian labor market. So that meant a whole chunk of people were taken out of the labor market and they left the Australian shores. So that created an acute shortage of people to fill those gaps, to fill those job vacancies. We opened the borders to invite more people in to fill those gaps, because we realized that sustained pressure in the labor market was putting a lot of pressure on wages, and because wages were growing continuously at a breakneck speed, we had the problem of inflation. So we opened the borders, we invited more people in, but then that brought along a new problem. Now, because we moved from the problem of absolute unemployment to structural unemployment, where while first we were finding it hard to find people to fill those gaps, now we are finding it hard to fill good enough people to fill those jobs. We have many people applying for those jobs, but they're not good enough for that job vacancy, which means our productivity suffers. Now, when our productivity suffers, I would like to take you back to the first point I had raised, that businesses are being forced to hire more because productivity is low. Now, because productivity is low, our hiring continues to rise, our hiring continues to increase, despite being in a very different macroeconomic environment. The situation we are in currently does not warrant such a tight labor market, yet we are sitting at the 4.1% unemployment mark for the last 6 months now. We've added an average of about 0.3% jobs every month, and it's only in October that employment growth inched down to 0.1%, which should have happened at least a couple of months ago. So productivity is a big challenge in Australia, and while initially it started off as not having enough people, now we have too many people, but none of them are working hard enough. So we are stuck in this terrible cycle of, hiring more people, but not generating output. Productivity remains low, wages are increasing, which further adds on to the inflation problem, as can be evidenced by services inflation, which still remains around 3.6 to 4% in our inflation metrics. So when it comes to immigration, I think the policies have to be a lot more forward-looking than just short term, because that is what I think impacted Australia the most. Our migration policies were very short term. We didn't have a good migration policy, forward-looking migration policy, which should have been more about only allowing those people to enter Australia with the right skill sets, which I believe is now in the works. I think our immigration policies have now changed, and we are seeing a better filtration of the people who are entering Australia.
Jamie, let me add something to that if I can.
Sure.
During the first Trump administration, when immigration policy tightened considerably, there was an unintended consequence in North America that the competition for skilled labor, especially technically skilled labor, ended up being favorable to our friends in Canada. Toronto became the startup capital of the world until the pandemic, because educated people from all around the world all of a sudden said, maybe the United States isn't the place we want to go. With immigration likely to be tight in the United States for the next 4 years, I think it would be wise for Australia to get in the game, to begin bidding for that global talent that might have otherwise went to Silicon Valley or places like where I'm at today, Austin, Texas, which is one of the emerging capitals of artificial intelligence. We're likely to not see that intellectual capital migrate in the United States because of the policy changes. And this is one of those hidden opportunities, I think, that's just sitting in plain sight. And I think, if you're in Melbourne, you're in Canberra, you're in Sydney, you want to get in that game, because that's the way you can stimulate productivity in the short term. It's a little different way of thinking, but right now there's a real premium on global talent, because innovation is what's going to drive all of our economies, and it's what's going to drive productivity, which is a key to lifting living standards.
Yeah, we definitely agree with that. We've had some of our earlier economic discussions have been the importance of increasing productivity and embracing new technologies to do so. Even the labour shortages are critical around the world. The skilled labour shortages are critical around the world. So that's good advice, Joe. Thank you. Joe, a couple of questions here just on federal government spending. Firstly, Mr. Trump has said that he's going to increase spending. So what areas and what's the increase in defence spending, noting the very interesting geopolitical issues that are going on around the globe? That's the first part of the question. The second part is a very interesting appointment of head of government efficiency in Mr. Musk. And Mr. Musk has said that he'll take a third out of government spending. So how does all this work?
So when I go around the world talking about the US economy, what I do is I tend to remove Trump from the equation, and I talk about what economic populism is. Right? Economic populism tends to move through the fiscal channel. Populists like to cut taxes and increase spending. In Trump's case, it will likely be through the defense channel and pretty big tax cuts for some esoteric areas of the tax code that he thinks may impact positively his constituents. So the U.S. deficit's likely to rise. Its budget deficit's likely to increase, not narrow in coming years. The U.S. spending on defense, that will increase to well over $1 trillion in the near term. And so the question, I think, is how long can this go on? Well, clearly the U.S. annual budget deficits at 6 to 7% can't continue indefinitely. Something's going to have to give. My sense is it'll probably be a combination of spending cuts and tax increases. over time. But for the next 2 years, don't count on it. Now, this is important because the dollar is the reserve currency. The US has that exorbitant privilege where it can spend more than it takes in. It can literally have its cake and eat it too. And because of the trade tensions that are just not exclusive to the United States and China, but most of the major economies in China, the world is moving into trade blocks. It's why I was very careful earlier to mention the global financial situation about how major US trading partners account for 95% of all currency reserves. Yeah, that's the US currency block. That's the US trade and finance block. Australia is a part of that. Vietnam, Indonesia, Malaysia, Singapore are all going to be forced to choose which block they want to be part of going forward. And that's at the heart of those global tensions and the regional trade and financial tensions that will be inescapable over the next couple of years. There's a great question in the chat about Vietnam, right? Because Vietnam, has got a really large and growing relationship, trade relationship with the United States. And I mentioned transshipments, the idea that Chinese companies are now setting up in other places like Vietnam and attempting to export in the United States. Trump administration is going to be focused on that. And there's going to be some tension there, real tension on the ground in Vietnam, because Vietnam's always caught in between China and the other major powers, whether they be regional or global. So Vietnam's going to be on the tip of everybody's tongue over the next 4 years.
Thanks, Joe. A general question, we are approaching the hour. Where do you both get your information from in this very news-crowded space? We're all grabbing information from different places. What do you rely on? And you can't say Bloomberg, because I know you both subscribe to Bloomberg Terminal. So what's a good place for information?
The economists at RSM are data-centric. We have data providers that we pay for, and then we focus on government statistics. And then when it comes to the global economy, I rely on the international institutions, the Bank of International Settlements, the International Monetary Fund, the World Bank. We're looking at the potential disruption next year of global finance due to the increase in the value of the dollar. I'm spending a lot of time inside the Bank of International Settlements looking at dollar-denominated debt, dollar credit, to see if the move away from dollar-based credit over the past 5 years has put select emerging economies in a situation where they're not going to be harmed in the way that they would have been 30 years. 30 years ago, the United States central bank increased its policy rate by 5%, and it tipped over almost every single Asian economy. That's not going to happen this time. That's actually progress. But we really are data-centric at RSM, and all of our economists are committed to starting with the data, and then our analysis proceeds from there. It's not a top-down thing, it's an inside-out thing.
Thanks, Joe.
If I may, if I may add, Jamie and Joe, I think Joe put it together really well, that data is what we rely on heavily when it comes to making sense of what's happening in the economy. But to a great extent, I would say, Jamie, that when I'm on the ground as well, speaking to the clients, I think there are often times when I'm wondering that how is it that these data, why is there a mismatch, and why is this not making sense? I think speaking to clients on the ground also helps a lot. So essentially, we start with data, like Joe said. We put it all together. We try to strip the noise in order to bring together the trend. But every time we are like hit with a roadblock, what's happening? Why is the data not moving as it is supposed to? That's where we try to also fill that gap with what we hear on the ground. And then we come back to our data, and we use those insights, and then we make sense of the trends, and then there we have our insights. So I completely understand where the question came from, that there's a lot of noise in the media. We don't understand what to listen to, but I think it always helps to just take a step back And if you want to understand what consumers are doing, think as a consumer. When you want to understand what businesses are doing, think as a business. And oftentimes, I think it would also help a lot to read the communication that comes out of central banks and central bank office bearers, because I believe those speeches are published. So that's another good place to get some insights from.
Thank you, Devika and Joe. I think we've got time for one or two. I know we've just clicked over the hour, but there's still more than 500 on the call. So we'll just might run one or two more questions. Joe, you mentioned at the start there's going to be a big change in capital flows for the US. Which countries, and if I could ask you to maybe focus on Asia Pacific and ASEAN, and then I'll go to Devika second, where do you think there'll be the biggest changes in the capital flows for those
Well,
countries?
I think that the countries or the economies that were the recipients of prodigious foreign direct investment are at risk of seeing those reverse, right? So you think the big three in ASEAN that are the developing countries, right? Vietnam, Indonesia, Malaysia. I think that's where you'll see that the most. Obviously, China is going to be having issues. And this is not dependent upon what's going on in the US. This has to do with their own deep domestic economic and financial problems. And as recently as 2015, 2016, China saw prodigious capital outflows. But make no mistake about it, with the growth in interest rate differentials between the US and its major trader partners, with those tariffs, with the fiscal expansionary policies that are going to be put in place, capital is going to flow from the south to the north, and most of it will be towards the United States. Outside of ASEAN, I think of a country like South Africa that's having some economic difficulties, that's got large external debt, large dollar-denominated debt. They're one of the countries that I'm most concerned with. They're going to be at risk going forward over the next couple of years.
Thank you. Devika, your thoughts?
I think I echo what Joe has said. He's spot on. I have nothing to add there.
Great. All right. Well, that takes us past the hour. So on behalf of everybody, we had a fantastic attendance today. Joe, thank you. As I said, Sunday night, you haven't even started your week yet. So we really appreciate your input, your insights, and sharing your experiences. You're very close to, in particular, middle market, USA and the world. So thank you very much for sharing your insights. Devika, as always, you've done a number of these now, and your views and your research are fantastic and spot on from an Australian context. So thank you very much for your commentary and for your answers to the questions, which were great. And thank you, ladies and gentlemen. You've been a wonderful audience, and the questions have been fantastic. And we are still bracing for impact. It sounds like for the next 6 to 8 months, we're going to be thinking about what's happening in Australia, because the Trump administration won't be in full force till the end of calendar 25, and in particular, it sounds like calendar 26. So we've got some time. We need to bring those interest rates down, I think, to help us all, and in particular our middle market businesses. Thank you, ladies and gentlemen. That's a wrap for today. Thank you.
Thanks, Jamie. Thanks, Joe.
Thank you.